Hey, how's it going everyone? Welcome back to my new video. Have you been thinking about investing into stocks but have no idea where to even start? Or you have no idea what stocks are all about? Well, then you have come to the right place. In this video, I will use easy to understand language to teach you what stocks and other important terminologies are. So I encourage you to stay to the very end of this video to avoid missing any important information. And with that said, let's get this video rolling. If this is your first time watching a video from this channel, then I strongly recommend you to subscribe to this channel as I go through weekly topics ranging from investments, personal finance, life plannings, and well-beings, so you don't want to miss out on those. Okay, so you have been contemplating for a while to start investing your monies into stocks, but you hardly know what stocks are, except they go either up or down. Alright Captain Obvious, let me explain. And just to remind everyone, everything I say in this video is for beginners and for general understanding purposes only. There are always exceptions, and I'm not going into all the technicalities in this video, so just keep that in mind. So today, I'll be talking about the followings. What are stocks, demand and supply, bidding and asking, stock exchange, dividends, bonds, indexes, ETFs, and mutual funds. So if you want to click on a specific section in this video, just click on the timestamp in the description box below. But as beginners, I think it is important for you to understand all these basic terms first. But I promise I'll make it easy for you. Okay, so what are stocks? In a general sense, owning a stock is like owning a piece of a company. If this company only has one stock, and you happen to own this one stock, then you own this company completely, in a general sense. Now, there are many publicly traded and listed companies in many countries, and the term public means that their stocks are open for the public to buy, to own. So in the stock market, if you own a stock from a publicly traded company, say Facebook, then now you're one of the many owners of Facebook. But in reality, a publicly traded company such as Facebook, Amazon, and Apple have millions to billions of shares. So owning that one share or one stock really doesn't mean much. But for the average person, the ownership isn't really something you need to think about too much, but the value of the stock is what you're interested in. If today you buy one share of Facebook, say $225, and a few days later you sell it off at $230, then you just make $5 from trading stock. The act of buying and selling stocks is what everybody's talking about, stock trading. So one interesting fact here for you to think about, just to make it more interactive here. Remember a few years ago in 2018, and you have probably heard it from the news also, that Apple became the first trillion-dollar company in the US. So how do people come up with this dollar valuation? Well, in this case, it's called a market capitalization, and it is simply an equation of multiplying the number of shares by the dollar value of the shares in the market. Now, I know there are preferred shares and common shares, that kind of nerdy stuff, but you don't need to know all these for the time being. Let's just collectively call them shares or stocks. They are used interchangeably for the average person. Now, to understand why stock prices go up and down, it is simply because of this concept called supply and demand. When more people want the same stock, meaning a higher demand, the price of the stock goes up. Prices go the same direction as the demand. So if less people want the same stock, the price goes down because the demand is down. Now, if there are more of the same stocks available, meaning the supply goes up, then the price will go down because supply and prices go different directions. And similarly, if the same stock becomes less available, meaning the supply goes down, then the price will go up. That is essentially what's happening in the stock market. When people found out from the news that this particular company is doing well, then people will rush to go and buy their stocks. Remember, when more people want the same thing, the demand goes up, and so is the price. So let's use the pandemic as an example. When people are not confident that the companies in their country will be doing well in the foreseeable future, then more people will be selling their stocks. So when you have too many stocks in the market, the supply goes up. Even if the demand stays constant, the price will still go down. So that explains why the market crashed at the beginning of a pandemic. The next thing I want to talk about is bidding and asking. It is very relevant to supply and demand. In a stock market, the minimum price a person is willing to sell his or her stock is called asking. And the highest price a buyer or investor is willing to pay to get this stock is called bidding. The average of the asking and the bidding price at that instant is the stock price. Say if at this given second, Facebook is trading at $235. What it means is that the lowest price the general market is willing to sell is $235.01, and the highest price the buyers are willing to pay is $234.99. and eventually one way will give way to the other due to supply and demand. Either someone will sell it at a lower price or someone will be willing to pay a higher price, and the price of the stock will either go up or down. So where can we buy and sell stocks? For the average person, you will need a stockbroker to help you list your buying and selling orders into the stock market. These stockbrokers could be your banks, your financial institutions, and nowadays, many apps also allow users to do stock tradings. I'll go into much greater details about stockbrokers in future videos. So once your broker receives your bidding or asking order, your broker will list it on a stock exchange, such as the New York Stock Exchange in the United States, Toronto Stock Exchange in Canada, London Stock Exchange in the UK, etc. Stock exchange is not just for trading stocks, as later you will also find out. But for now, let's get back to the stocks first. One more thing about stock is that some of them pay dividends. See like a bonus for keeping the company's stocks. Generally speaking, when a company is doing well, a portion of the profit can be distributed to shareholders like you and me in the form of dividends. From the stock information sheets, this dividend may be called yield. For example, a 5% yield means that at this particular time, the latest dividend paid out is equal to 5% of the stock price. If the stock price is $100 and the company pays out dividend once a year, then the latest dividend given out to shareholders was $5 per share, which is a 5% yield. But keep in mind though, this 5% is per annum. Some companies like to pay out dividends monthly, quarterly, or annually. But in the end, if you add up all the dividends in the whole year, it will equal to 5%. So don't get too excited. It is not 5% per dividend paid out. Now, there are pros and cons to stocks with high dividends, but we will talk about that next time. Next, we have bonds. Bonds are loans. If you hold a bond, that means you're lending money to the company, and in return, you'll get regular payments from the company as interest. Now, the calculation of bonds and interest are very complicated, so we won't get into that in this video. But just know that you have the ability to lend money to companies, and in turn, you get a piece of their bonds and get regular payments as interest. Both the high dividend stocks and bonds are invested in similar objectives, which is to get fixed income periodically in the form of dividends and interest. Stocks can be traded easily on the stock market because there are lots of buying and selling movements, but bonds on the other hand are not traded that regularly. So you may need to seek out companies or banks to help you get those bonds. Very often, you will also hear this term called index. It means a collection of selected stocks. Indexes are not any entities, they are just names given to any particular groups of stocks. For example, the most popular one, the S&P 500. It has 500 largest US companies having their stocks to be part of this index. Another two major indexes are the Dow Jones Industrial Index, or DJI for short, and the Nasdaq Composite Index. All these three indexes have their own combinations of stocks in the US stock market, and they generally give you a good sense of how well or poor the economy of a country is moving in a certain period of time. As an investor, you have the option of investing into a singular stock from a company, say Apple, or you have the option of investing into a basket of stocks, say a stock each from Google, Amazon, Apple, Facebook, and Microsoft. Now you just purchased 5 different stocks from 5 different companies. But sometimes it is quite troublesome to handle all 5 stocks at the same time, so some people may consider getting an ETF instead, short for Exchange Traded Fund. They are funds that carry a basket of many different stocks and are available for investors such as you and me to buy from the stock market. So instead of buying 5 different stocks yourself, you just have to buy a particular fund that has all the 5 stocks that you want. There are so many ETFs in the stock market with all kinds of combinations of stocks, just like how TV streaming services work, like Netflix, Disney Plus, and Amazon Prime Videos. All have their own combinations of TV shows and movies. Sometimes, some movies may even appear in more than one TV services, so there are some overlappings here. So just like TV streaming services, different ETFs have different combinations of stocks and sometimes even bonds. So you have to do your own research and see which one carries the stocks that you want. But of course, if you subscribe to this channel, then you'll be notified when I make a video about which stock or ETFs to buy in the future at that point in time. Another similar concept is mutual fund or unit trust in some country. They're not the same thing technically, but some countries use them interchangeably, so just FYI. So a mutual fund is a larger version of ETFs with more complicated stuff inside. On top of the stocks, a mutual fund can also carry bonds, foreign stocks, and foreign currencies, among many other things. And a fund manager is assigned to manage the allocation of these individual components inside the fund. Just like stocks, ETFs and mutual funds all have different prices at different times and different days. So which one should you choose? Well, generally speaking, if you want to buy and sell fast, then buying individual stocks is the way to go. But if you want to invest in something for long terms, like for years and decades, then mutual funds are more suitable, while ETFs can be suited for both scenarios. As a beginner, I wouldn't worry too much about mutual funds for the time being, but I would focus on companies that I have heard of first. Some websites like Yahoo Finance is a great starting point for you to get familiarized with the stock market. So with these few introductory terminologies, you should have a better understanding of stock trading and the stock market. In the next video, I will show you a few easy to follow steps to help you start investing your first dollar, so stay tuned to that. And if you find this video helpful, please give this video a thumbs up and subscribe to this channel to get notified for more videos in the future. And as always, thanks for watching, and until next time, peace out.